Hello and welcome to Women's Wednesday on the Money Show. I'm Kavita Thapliyal and this is the space where we talk about money independence and the financial choices that shape women's lives. So women today are earning more, investing more and managing households and businesses, but financial planning is still an area where many hesitate to take the first step. So today we are discussing how women can build confidence with money and plan their finances more effectively. All you can do or to participate on this show, you can send across your questions. If you are a first-time investor or you've been investing, you need some kind of guidance on your financial planning. Our experts are there to help you out with that. Send across your questions on the WhatsApp number that's flashing on the screen and also the email ID that's flashing. Send us the details of your existing investment and your financial goals for which you are investing, and you have the portfolio, and our experts will help you right there with all your strategies. But let's begin and let's welcome the guest on the show. It's Harshwardhan Roongta who will be helping you navigate through all your financial decisions. Harsh, hi, good evening. Welcome to the show. And interesting set of questions from women and questions from women for their daughters as well. So this is one platform or one window where every week, Harsh, we talk about all aspects of women financial planning. And given the week, there's also Women's Day coming up in a couple of days. So this Wednesday gets all the more special, for our women and for women financial empowerment. So let's begin with the first question. Harsh, this is from Soma Prakash, and she wants to know about her daughter. In the sense, she wants to invest for the better future of her daughter, and for that she wants investment plan. So thank you so much for sending us your question. And yes, a very crucial part of your financial planning and financial goals. Harsh, what is the bucket in terms of going right and wrong when it comes to financial planning for your daughters, for their better future, for securing their future? Let's just talk about the wrongs first, because I'm sure with the rights we'll also come down to be discussing the financial strategy or portfolio details. But what are the wrongs over there?
So, hi Kavita. A very important question, very relevant, because it is important that you plan for your children's future, be it daughter or son for that matter. You plan for them well in advance. I'll tell you two things that parents usually tend to miss out. The
Right.
first is they tend to, just simply neglect the fact that when a child is just born, you can start an investment plan specifically for that purpose to say that I would use this corpus to meet the requirements of higher education and marriage, probably 18 or 20 or 25 years later from now. So, children, parents usually miss that journey when the child is just born, you can start saving for even 50 or 20 or 25 years. So I think that's a great advantage that they can take when the child has just been born, so that the larger corpuses can be accumulated. The second is there's a lot of misconception behind names of investments. Like if there is something that comes up with a children benefit plan, children something, so parents tend to get a little emotionally carried away with that nomenclature of the schemes, and they tend to invest into products which may not necessarily be the best investment products. I'm referring to specifically for children's plan offered by insurance companies, etc., where parents tend to get a little, swayed away by fancy names that promise good future for the children. But nevertheless, you have to be very mindful of what you're planning to do and how do you want to create that corpus. So, for example, when you plan for long term, and especially if you're planning for educational expenses or marriage for that matter, you must understand the inflation which hits educational expenses is far more than what a consumer price index would be. So it's more than the inflation for goods that we are buying. It is going to be different. So education inflation would be in excess of 12%. Now, if you are going to invest money which grows at 6 to 7%, you're not going to beat inflation, even the basic increase in cost of education that is going to take place. So, what's the right thing to do? One, you must be very clear as to what you're trying to achieve with your investment. So, it could be for a period of 18 years for education purposes, it could be for 20, 25 years for marriage purposes. So, you have to have a basket of both. I'm not saying don't invest into conventional, traditional, and safe investments, but you need to have a basket of
Right.
debt and equity. So debt could be serviced very well for a girl child through Sukanya Samriddhi Yojana, And
Right.
for the long-term wealth creation, beating inflation products, you will need to opt for SIPs in mutual funds and invest into equities.
Okay. That's important, and since Soma is also trying to plan for her daughter, you've named out the investments, which is Sukanya Samriddhi as far as debt is concerned, and, for equity, she can have a combination that can be designed. But just in case, if there is no portfolio yet, how can one go about it? For example, if it's an education goal, which has to be the first priority, how can one align that goal? What are the ingredients needed to come to that particular corpus that might be needed?
Yeah, so the first and foremost, you'll have to identify what is the targeted sum that you're planning to accumulate. So it could be a hypothetical figure. Just needs to be a little thought, after a figure, not just a very random figure. So what you could do, if it's education that you're planning for, then you would need to just look at what is the average cost of education in present times. So if you say that I want to get a good graduation degree plus a post graduation, etc., if it costs anywhere between say 50 lakhs to say it could be 5 crores for that matter, so you just need to come to a realistic figure to say that what is it that I'm trying to accumulate, and after how many years am I going to require it. So it would be say for example 1 crore for example, and you say that I have 18 years to accumulate this money. So you've got two very clear factors that you have identified. One is that you need 1 crore, and the other is you need it after 18 years. Then the question arises, which product do I need to invest into so that I can achieve my target? So now you identify an amount that you can set aside for this purpose. So it could be, say, for calculation purposes, again, you say that I want to put 10,000 rupees away for this educational purpose of my daughter. Now you have to do an asset allocation, which means that as I said, you need to have a basket of both. You need to have a Sukanya Samriddhi Yojana, and which is like a capital protection kind of a scheme. At the same time, it gives you an 8.2% interest, which is tax free. On the other hand, you need some investments which will beat inflation, grow at a much higher pace than what cost of education is going to go up by. So that is your equity mutual funds that you invest via SIP. Now you've got 10,000 rupees, for example, that you've allocated for this purpose. Now you need to decide how much goes into the Sukanya Samriddhi and how much goes into mutual funds. So ideally, because you have 18 years of time horizon, I would say you do an 80-20. So which means 80% would go into mutual funds through SIPs and 20% into Sukanya Samriddhi for capital protection. Because over long term, equities are supposed to be giving you better returns, and they have a past history of giving you double-figured returns. You would want to maximize upon that. So an 80-20 kind of an allocation between Sukanya Samriddhi being 20% and mutual fund SIPs being approximately 80%. That's the path that you will take for your children's higher education planning.
Absolutely. So that's a mix one needs to have for an education goal, especially if you're talking about daughter education. Do include Sukanya Samriddhi. That will be a good add-on to your entire basket of investment instruments. But let's move on. Harsh, let's take Prabha Kumari's question. And she's investing in two funds via SIP since last July, and HDFC Flexi Cap, ICICI Multi Asset. She's investing 3,000 rupees each, and she needs 25 to 30 lakhs in next 10 years. She wants to know what should be the ideal SIP amount to achieve this goal, or if there could be any other fund that she needs to add. So, I mean, both are good funds, maybe, but then let's talk about the goal first. 6,000 rupees and 25 to 30 lakhs in 10 years. Is she on path?
No, in fact, unfortunately, if I just take 12% CAGR calculations and we exfoliate the 6,000 rupees that she's investing every month,
Right.
after 30 years, that's what she's looking, after 10 years rather.
10
So
years,
after
yeah.
10 years,
Yeah.
if we take 12% assumption of returns, she would get about 13.75 lakhs. So that's at the
Oh,
assumption of 12% per annum and
okay.
10-year time horizon. So
Okay.
if she needs 30 lakhs, of course, her investments would need to increase and go up to at least 13,000 rupees per month. Then at the rate of 12%, she would assume about 30 lakhs is what she will get. With regards to her portfolio, you rightly identified that both the schemes that are in her portfolio are nice. So there is no complaint on that part, and there's no need to make any changes there. However, if she wishes to increase her SIP, because we've also calculated that she needs to increase her SIP to 13,000 rupees. If that was the case, then she could most certainly, there are two options. One is that she adds into the existing schemes that she has. So she has one flexi cap and a multi-asset fund. In addition to this addition, she
Mm-hmm.
can add a pure mid-cap fund in her portfolio as well. So a Kotak mid-cap fund could come into her portfolio. However, from an allocation standpoint, whatever her monthly investments are, she should ensure that only up to 30% is going into this pure mid-cap fund. The rest 70% should go into the flexi cap and the ICICI multi-cap that she already has.
Let's move on and let's take Leela's question. She's from Rajkot and she wants to invest 5 lakhs and she wants to invest this for 10 years. What will be the roadmap is what is the question. Very interesting time, and Leela, one has to be really bold to invest at a time, Harsh, when the markets are shattering all around the globe. I mean, the global market is in jitters because of the war situation going on. But having said that, for investors like Leela, who actually has the nerves to invest during such time, this will only prove beneficial for them in terms of their portfolio returns, and she's investing at a time where we are expecting the market to slightly be in this particular range, but timing never matters. It's always the time duration and the time you have spent in the market. So 10 years, again, a very good time for her. How would you like to help her?
Well, very interestingly, Kavita, I mean, markets are in a turmoil. I mean, you can see markets crashing and investors are nervous. But this is a great question at this time because, real money is only made when you have invested when the markets are in great depression. So real money is only made during these times when markets are crashing, and then you have the nerve to actually start investing at this point in time. So to that extent, I think it's a good question to come at the right time, where people would be wondering that, yeah, I have invested, I want to remove money from the market, and there is another investor coming and saying that I want to put money. So, well, again, I repeat again, just so that we understand clearly, the real wealth is created only when you invest during the times of turmoil and not during good times. So, if you're investing during good times, you will make returns, but real wealth is created when markets are in turmoil and you put your money there. Now, what's the right time to invest, etc., is another topic. We will not get into that. Now, coming to Leela's question, well, if she has that risk profile and she understands the functioning of how volatility is going to span out, then I would suggest that she invests this money as lump sum. Now, within lump sum, there are two options. One is that she goes into a 100% equity fund, which puts all allocation to equity right now itself, or she goes for a dynamic asset allocation fund. So I would suggest the latter. I would suggest that she invests into a balanced advantage fund, because the structure of these schemes is that they will invest into equities depending upon what the valuations in the market are. So, for example, if the market valuation is low, they will put more amount in equity and less in debt. When the markets go up, the formula says that they will reduce their equity exposure and increase more in debt. So basically, this is actually working on the theory that people want to do, is like buy low and sell high. Now, this kind of a scheme actually enables to do this on a preset formula basis. So, balanced advantage fund would be a good category for her to put a lump sum at this juncture. I could recommend that she splits the 5 lakhs into two schemes so that you get the benefit of two different fund managers. One would be ICICI approved balanced advantage fund, and the other would be SBI balanced advantage fund. So if she understands these nuances that I spoke about, she has a long-term horizon, she's already mentioned that, and she can fathom the volatility, then I would suggest that she goes into the balanced advantage fund category, and the two schemes I've already recommended.
All right, so that's the takeaway for you, Leela. Keep in mind that you shouldn't delay this money, and as explained, you should be staggering it for better returns. Now, since we are having her stagger the amount, do you also want to explain the process where she needs to put the money somewhere in maybe a liquid fund, and then from there she can make an investment, or directly from wherever this money is, maybe assuming if it's a savings account, she can just give a mandate to a particular fund?
So, Kavita, in this sake, in this particular reference point that we're talking about, if she's not comfortable making a lump sum investment, so we've already suggested that if she
Yeah.
understands the market, she wants to make a lump sum investment, she can go ahead right away and invest into the two balanced advantage funds. Now, if she is not comfortable with that, that's an interesting angle for sure. That if she is not comfortable with putting lump sum right now, there is a concept of systematic transfer plan, wherein the initial amount, the corpus, the 5 lakhs she puts into a liquid fund, she parks it with a fund house in a liquid fund. And thereafter, she gives a standing instruction to the fund house saying that every month you transfer money from a liquid fund into the targeted scheme. It could be a balanced advantage fund, it could be a pure equity fund, it could be whatever. So, what a fund house will do is every month they will transfer money from the liquid fund into a pure equity fund or a balanced advantage fund. So, this is a systematic transfer plan that we're talking about. So, she has both the options. In fact, all your audiences would have both the options. If they understand the nuances, go for lump sum. If you do not, then opt for the systematic transfer plan.
All right, let's move on and let's take other question. Very interesting question, and this is by Fatima. Fatima is asking that she's heard a lot about NPS, but she's confused whether she should be investing in this particular scheme or not. And most of the schemes under NPS are not in profit, is what she's realized. She has mutual funds, and if the goal is retirement, she's thinking whether NPS has to be an important addition to that, or can she just accumulate her retirement corpus through mutual funds also?
Well, again, very interesting. I'm happy that this question came up because,
Right. Yeah.
again, the nomenclature that we talk about, and we spoke about in another children-related investing. So when you say retirement, everybody thinks of pension, everybody thinks of some retirement product. Well, so how do you plan for your retirement? So there are two phases of planning for retirement. The first phase being accumulation phase, wherein you are going to be accumulating that corpus. So this is the period, say you're 30 years old, going up to age 60. So from age 30 to age 60, you are only investing money. So the money is outflowing from your pocket, getting accumulated into a corpus. At age 60, that corpus is available. And thereafter is the period where you're going to get the money back from the whatever investments you've done. So there are two different stages. Now, stage one, where you're accumulating that corpus, you could accumulate that corpus through a product like a mutual fund. You could just simply keep investing into mutual funds, into whichever type of schemes that you want. You review them, you make changes, whatever you want to do, you do that. And at age 60, it will accumulate into a corpus. Deploy that corpus to get regular income. Now, that deployment of that corpus could be again into some mutual funds where you do an SWP. It could be a fixed deposit where you start earning interest from. It could be a property where you get rent from, or it could be an annuity plan where you start getting pension from. So the accumulation phase is through mutual funds. The distribution phase is either of many other combinations that I just mentioned. Whereas in an NPS, this accumulation and distribution is structured already. It's a pre-packaged product and it is being offered to you. So which means at the age of 30, this person enters into an NPS as a product. The accumulation will happen only through that NPS product and the fund managers that are linked to NPS. At retirement, you will get an option to withdraw a certain portion of that money as commutation. Thereafter, the amount will compulsorily get transferred into an annuity plan. So you don't have an option at that point in time for the remainder amount to put into a property to get rent. You can't put that in a fixed deposit. You can't do all of that, but in the locked-in amount. So both products have their merits and demerits. It is dependent on each individual as to whether they want a locked-in kind of a structure, whether they want the flexibility to choose what they want to do. Depending on that, there are both options which are available. So it would be wrong to say one is better than the other. I think it is purely an option given to investors. You have an option, you take NPS, and who would take NPS? Those investors will take NPS who do not want to manage the fund on their own. They want a lock-in structure. That is the primary agenda of NPS. There are a few withdrawal options available wherein on happening of certain occasions, you could withdraw a portion of that corpus, but you can never withdraw the entire amount. There is a lock-in up till age 60. At age 60 also, you will not have access to the entire corpus. You will be allowed to withdraw only up to 60% of it. Rest balance 40% has to be compulsorily converted into an annuity plan. Whereas in a mutual fund, the entire flexibility is yours for the entire period at the time of accumulation and at the time of withdrawal. So I think it's most appropriate that each individual picks a model which suits them. If you ask me, anybody who's hands-on onto managing money themselves or has the wherewithal or confidence that they can manage on their own, should most certainly take the mutual fund route because it is far more flexible, far more efficient in terms of making changes if you have to. And with regards to somebody who's not from the finance field, does not want to get involved into lots of managing and maintaining that discipline and wants a lock-in kind of structure, then NPS is a better product for them.
All right, very interesting, and I think the conversation can just keep going on. There are so many aspects to it, but then yes, a direct takeaway to Fatima is that you can really achieve your goals through mutual funds as well. But then let's move on. We are not left with much time on the show, Harsh, and let's take Lovely's question. And just like her name, the question is also lovely. She is based out of Punjab. She's doing her MBA finance, and she wants to start her own food truck in Punjab. And she wants to financially plan for this. So lovely, congratulations. It's a lovely goal to come up with. And yes, food trucks are in trend. We just hope from Punjab you also come down towards other parts and just expand and come to Mumbai as well. But then, yeah, Harsh, I think the chole bhature is something that's already on the menu. It's at least in my mind that Lovely wants to have it. Harsh, how can you help her?
Well, it's so nice to see the entrepreneurial,
Right.
aspirations,
Yeah.
and I do someday hope that I would see some food trucks in Maharashtra as well, besides
Right. Sure.
Punjab, named a lovely food truck. I mean, I will be very happy, and my best wishes to you, lovely, for this. I sincerely hope you succeed in your aspirations.
Yeah.
Well, when it comes to finances, well, there are two aspects that you'll have to keep in mind. One is that you need regular cash flows to maintain your business. So that is the one part. So you have to establish that business and you need cash flows to maintain that business for a certain amount of time at least until the business generates positive cash flows to that extent that you have surpluses. The other element that you need to be very careful about is that when you get onto this entrepreneur journey, there is going to be a period where your business may not generate cash flows enough for you to take it out of the business. So, how do you meet your personal expenses during that time? So, there would be living expenses that you need to provide for. So, ensure that you have a corpus equivalent to at least 1 year of your living expenses, personal living expenses. I'm not talking about business expenses at this point in time. So hypothetically, again, if you have a monthly expense, living expense of 50,000 a month, you need to ensure that at least 1 year's worth of that living expenses, your food, clothing, shelter, that should be available to the extent of 6 lakhs at least. Only then you plunge into starting a new business. Now, when you get into the business, of course, being a food business, it is a cash generating business. However, initially, my belief is the capital expenditure, the raw material, etc., that you would require may gobble up this cash flow that you generate out of business. So there is going to be a situation where whatever you're earning may get into redeployed and reinvested into the business. So let that try and be automatic and auto financing itself. If there is capital expenditure, of course, you need to get some source of funding those capital expenditure. Like you need the food truck, for example. You need the licenses. You need all of those things, which is a capital expenditure for you. Besides that, on a regular basis, you'll have raw materials which you need to provide for and all. But again, just summarizing it for you, ensure that whatever your personal living expenses are, food, clothing, shelter, that equivalent to 1 year's expense, you have it ready and do not deploy that in your business. And
Mhm.
other than that, the business, of course, is cash generating, but just until it becomes positive enough for you to remove money, remember, you will need to only, keep trying to make it self-sustainable.
All right, I think all the best over there, lovely for you. And if in case any more doubts, you need clarity on any aspect, just write down again and we'll be happy to help you. But with that, it's a wrap on the show. Thank you so much, Harsh, for taking your time out and helping our viewers and our women viewers with their financial portfolio today. Thanks. And it's a wrap, but I'm going to leave you with our WhatsApp number and email ID. In case you want to send across your questions, please do that. Thank you so much for watching. Goodbye.